updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, NASDAQ, another leg higher. 43 minutes to go until the closing bell. Big move for the S&P. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks with an aggressive bid today and trading at session highs. Dow's currently up 530 points. S&P's gained 73, while the NASDAQ is higher by 288. The U.S. 10-year yield jumps to 2.91%. Gold is down 25. Oil is also slumping. And Bitcoin is higher by 1.7%. Among the main 11 S&P sectors, only energy was in the red. And leaders to the upside in the Dow, Nike, Boeing, and J&J, while travelers fell 5% after earnings and led to the downside. In other news, Dentsply plunged as much as 15% after preliminary Q1 adjusted EPS missed estimates and the CEO was terminated. In deal news, Blackstone to buy American Campus for $12.8 billion. And wrapping things up, Netflix and IBM report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
All right, we thank you very much, Bill Maloney. He's got us covered. And to hear live breaking news over your Bloomberg Type Squawk SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So I have to say, I brought up this next story on a call that I had with CEOs and co-founders ahead of the upcoming Milken Summit.
Yeah, because we're all in on ESG at Milken this year.
It's absolutely.
And by we, I mean the panels that we're hosting. But it's a huge theme at Milken.
Right? They all have a take on that. And Milken's 25 years in, so they've been talking about these issues for a long time. This story, by the way, also among our most read on the Bloomberg.
Jenny Serrain is the person who wrote this story. She's finance reporter for Bloomberg News. She's with us now in the Bloomberg Interactive Brokers Studios.
Did you just check her watch? Did you just check your watch?
Busted, Jenny. I did not see Jenny Serrain.
Speaking of busted.
What?
Well, if you work for MasterCard, right?
Oh, okay. If you don't go all in on ESG, you're not getting a bonus.
Is that
exactly right. Yes. So they started this last year, and it was starting with the executive vice president level and above. And now they've said, yeah, anybody that works at the company, your bonus is contingent on the company overall meeting some of its ESG goals.
Is that a new thing for them?
Yeah, so they just started this last year. They're expanding it now this year to include everyone. And they've had this long-time focus on ESG. So I think this is really just them saying, you know, we're all held accountable for doing this.
I think a lot of people listening right now might say, wait a second, it makes sense that a company would tie bonuses to its own financial performance, how it does in terms of profit, how it does reaching certain financial metrics. But this one, how aligned is ESG with how well the company does financially?
Yeah, I mean, I think in MasterCard's mind, they're very aligned. One of the goals that they have, for instance, is around financial inclusion and bringing more folks into the digital economy. And the more they do that, the more likely they...
Meaning the more people that are using MasterCard products, the more money MasterCard is going to make.
Potentially, yes. So if you're, completely out of the banking system, then it's highly unlikely you'll have a MasterCard in your wallet. And if they bring you in, then it has the added benefit of, being good for the world and being good for their company. So I think in their minds, that's one of them. But also I think they realize that employees like when companies set these goals. It's a retention effort. It's, something that employees really do care about. And so they're putting their money where their mouth is, and they're linking these two things up.
That's one of the things I keep hearing from CEOs and leaders of institutions, especially in a tight labor market, that they're like, listen, our employees, our workers, they are demanding that we, sit up straighter when it comes to a lot of these ESG issues, not just talk, but actually do something.
Yeah, I think that's exactly right. Especially for younger employees, when you're going out into the market, it's, they see that you have these and they want to work for a place like that.
Can I ask you, though, how much is also connected to, I feel like the SEC is increasingly crawling towards greater disclosure and ways of apples-to-apples measurement of ESG by publicly held companies?
Yes, I mean, that's definitely true. I think we're still a long way from anything formal coming, but that's something we hear all the time from these companies as they put out these massive reports and set these targets, that there's really no clear way to compare across companies, whose goals are better than the other, who's done better than the other. So I think hopefully we get to a point where maybe that's a little bit easier, but for now, we're probably going to keep seeing these kind of piecemeal things.
So what do we know about the metrics that MasterCard specifically is using in order to evaluate how its employees do with ESG? Because
I want to know if I work at MasterCard, how I'm going to be measured.
Well, Carol and I talk about this all the time when we talk about ESG. What we find is that companies, even though they have lofty goals when it comes to ESG, and we're in the midst of earnings season right now, the companies are not getting punished by investors for missing ESG goals. They're getting punished for missing top line and bottom line in guidance.
That's definitely true. I mean, I think, so the goals that they're factoring into bonus are efforts to reduce carbon emissions. They have like specific targets around the amount of carbon that they're going to get out of their operations over a certain time period. They have the gender pay gap. They're one of the few companies that gives a very blunt assessment of their gender pay gap. And so efforts to close that are going to now be part of the bonus calculation. And then that financial inclusion goal. And I think it's hard to see where this all translates into dollars and cents on the bottom line. I think with the financial inclusion one, there's that kind of, it's a little bit of a stretch, I think, but I do think that this matters from an employee perspective, and if your employees are happy, then they're probably more productive, and so I think that's how a lot of these companies get around to justifying these moves.
More broadly, are we seeing this kind of happen? Like, I think is there another firm that if they came out and did this, everybody would be like, oh.
Yeah, I think everybody's going about it differently. I think there's a lot of companies now that incorporate D&I, diversity and inclusion, into bonus calculations. So that one I feel like is a little bit more common. I think that, the fact that every employee is going to be held accountable for MasterCard's carbon emissions is really interesting. And, it's probably hard for some lower level folks to really understand how they can play a role in that. And I think the company will have to, that will be on the company to kind of explain to them what role you can play.
That's a really good point. Like you feel like the decision makers in many ways really kind of control how this goes, right?
I think that would be an easy argument for, and a MasterCard employee to make. But I also think, if not everybody is held accountable, then it's easy for this to kind of stuff to fall through the cracks.
Jenny, I'm wondering if it has to do with travel too, and employee travel, because I don't know, when we book our flights here internally, we use a tool that actually shows us the carbon emissions that are coming from the flights that we book. So does it maybe tell MasterCard employees, maybe you don't need to fly to this place?
I'm sure that's a little bit part of it, and definitely MasterCard, their actual carbon emissions, compared to like an oil giant or something like that, is very different kind of carbon emission map or what have you. And I think, also another big thing that they've been really big on is how customers use their cards. So they have lots of tools actually that can show you, if you make a purchase, how much carbon was tied to that purchase.
I feel like it's great awareness. It's just like when you start putting calories and the composition of what you're eating really kind of raises our thing. By the way, I checked my watch when I first sat down, so I was kind of ready to go home already. So don't take it personally. None of you. It's just that kind of a day.
Maybe she got a message. Maybe it's a smartwatch and she got a message.
I love Jenny Serene and all that she does. Jenny is finance reporter at Bloomberg News, and you can find her at Jenny Serene on Twitter. You're listening to Bloomberg Radio. I did check my watch.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Hi, this is Bloomberg Business Week. I'm like a little wacky Tuesday here.
Well, fortunately, we are going to check in with Kriti Gupta in just a minute, and she has
You didn't have a segue there, did you?
No, because we're both wacky today, so our wackiness cancels each other's wackiness out. So it's working, do not worry. But I'm excited about this chart of the day because it's about travel.
Yeah, and masks. We're going to get to that in just a moment. First up, though, let's get back to your top business stories. A look at that market day. Charlie, just 29 minutes to go.
Indeed, and I'm waiting for a wacky Wednesday from you guys. Keep in mind, tomorrow's 420 day. We'll leave it right there with the Dow, the S&P, NASDAQ all advancing. S&P right now up by 74 points, gain of 1.7%. The Dow up now by 524, up by 1.5%. NASDAQ up 295, up by 2.2%. Key takeaway, best level of the day, 28 minutes to go. Stocks gaining in a broad-based rally. Look at the Russell 2000 up now by 2.2%. Investors weighing the resilience of the economy against prospects for aggressive policy action to curb inflation. Treasury yields are climbing. The 10-year right now 2.93% on the 10-year yield. Spot gold down 1.7%, 19.45 the ounce, while crude is tumbling 5.1%. WTI 102.64 a barrel. Most major American airlines are no longer requiring travelers or employees to wear face coverings on domestic and some international flights. So what are the potential risks for passengers? Dr. Amish Adalja is senior scholar at the Johns Hopkins Center for Health Security.
If you're a high-risk person, yes, there's always going to be a COVID-19 risk, and you have to continue to think about wearing masks in high-risk situations. I don't think airplanes themselves are very high-risk situations because of the number of air exchanges that occur, but maybe the subway, a bus might be. But remember that one-way masking works. You can get access to an N95 or an N95 equivalent and wear one of those masks if you're in one of those high-risk situations. Just because the government doesn't require it doesn't mean you can't do it, or doesn't mean that the airlines themselves can't require it.
Dr. Adalja with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Pfizer shares down 3%. Shares of its German partner, the ADRs of its German partner BioNTech, up now by 0.6%. AstraZeneca's ADR is down 0.4%. Moderna out of Cambridge, Massachusetts, down 1.9%. Johnson & Johnson reported earnings this morning up by 3.4%. Briefly, Netflix and IBM both report after the close of trading today. Netflix up 3.5%, IBM up by 2.3%. And that is a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. Carol Master along with Tim Stenovic here in our Interactive Broker Studio. And what are we doing now?
As we do each and every day at this time, we check in with Kriti Gupta for her chart of the day. If you are still one of the few people who has not signed up for Kriti's chart of the day.
Sign up already.
Yeah, just send her an email, kgupta129@bloomberg.net. You can also check her out on social media, Instagram, Twitter, at Kriti Gupta News, kgupta129@bloomberg.net, because you get really cool charts like this.
And you get a free mug. No, you don't get a free
what?
mug.
I'm still waiting on my
that,
mug. Have fun sending mugs out to everyone. Wow, that would take forever. Kriti, we are talking returning to the skies. We're talking TSA checkpoint throughput. How are we doing? Are we getting back to pre-pandemic levels?
We're getting really, really close.
Okay.
But this is what I think is so interesting, because this is coming on the heels of the mask mandate, which I think is everyone's kind of talking about. Being lifted. So for those of you who aren't familiar with the story, a federal judge in Florida overturned the national mask mandate, which essentially means that you had to wear masks on trains, planes, automobiles, and basically the CDC had extended that until about May 3rd, I believe. So we got a few weeks on that. So the federal judge said, no, we're not doing this. And right after overturning that ban, and once again on a national level, the U.S. Transportation Agency said, you know what, we're not going to require this on planes anymore. And remember, this is something that a lot of airlines were lobbying for, because they said, masks are uncomfortable. It's going to eat into people's kind of traveling. They're going to try to travel another way. So you actually saw airline stocks rally on the back of this. What's interesting, though, is the way this is being interpreted, right? If you see will you see more travelers encouraged by no masks on planes or discouraged?
Tim has a ton to say.
I don't know if you were watching the simulcast, Creedy. You were probably busy doing other things. But I said, I talked about airline stocks moving higher today.
Yeah.
You were with me yesterday co-anchoring. I talked about them not moving higher yesterday after this was announced. There seems to be a delayed reaction from investors here, but I'm puzzled as to why investors would be sending shares higher today, because I just don't see the logic in people traveling more if there's a mask mandate lifted. Like, it didn't seem like the type of thing to me that would hold people back from actually going somewhere.
I think this is where you have to speak very carefully about it, because it gets very political very quickly when it comes to mask mandates and whether or not people are comfortable with it. I mean, there are parts of this country that I think are more, I don't want to say stubborn, but more clear or more sticking to their guns in terms of whether or not they want to wear masks and the comfort level about it. I mean, remember, I don't think masks are particularly comfortable. And I think that does eat into whether or not you choose to, say, take a road trip instead of fly.
Okay, that's a good point. Road trip versus flying. But if you want to go visit grandma and the only way to get there is to fly, you're going to wear a mask for a few hours to go and visit grandma.
See, I just think it's all kind of a rollback to, okay, wait, we're getting more normal.
So if we do see a move higher with travel stocks in general today. We see oil down also. So you think that's it, Carol?
Oh, could be, right? I don't know.
Yeah, and I think part of it, I think to your point about this is getting back to normal, look at what Johnson & Johnson did today, right? They suspended their vaccine guidance, and I don't think this was, I think this was initially interpreted as, oh, well, Johnson & Johnson suspending it because they're concerned that this isn't going to bode well for the earnings. But if you actually look at what their earnings are, vaccines don't make up a good chunk of
They were running it as a nonprofit, essentially.
Yeah, they're running it as a nonprofit, and also they don't make up the enormous kind of vaccine base anyway. So to say that, well, we're going to suspend our guidance, I wonder if that's another way of saying, well, this isn't really relevant to our guidance, and that really goes back to, are we getting back to normal where earnings don't depend on vaccines?
And I feel like I'm a hedge fund, here we have to just kind of pull in data from really kind of various points, maybe not traditional ones, to try and get a feel of, are we getting back to normal when it comes to the economy? What about with natural gas? Anything normal there?
Nothing normal there, actually. Natural gas is supposed to be boring by definition. The idea that it's purely based on weather, which you can predict, and you trade it, because the U.S. natural gas market is insulated in a way that European gas market is not. So when you've seen this crazy volatility in European natural gas, American natural gas has been kind of muted until now, where you start to say, well, okay, well, if you're not going to get your natural gas from Russia, and maybe you might get more natural gas from the United States, which is a net exporter, by the way, of natural gas, and that infrastructure is starting to slowly get built, that's where natural gas prices really matter. And they are on a tear. Prices doubling this year to the highest since the shale revolution more than a decade ago.
God, that is such a different trade. If you think about what we've seen, and we've all talked about how low nat gas is, and you've seen homes and different, kind of pivoting to that in terms of their what they have to count on. It's interesting. We'll just have to see if the trade sticks, right, ultimately?
Pretty much, but I think a lot of people are also just playing this as, if you need a hedge, if you need an inflation hedge, hop into commodities, any commodities. And natural gas is literally on a tear right now, so you can't really go wrong with this. And that's not investment advice. That is just purely on a chart basis.
Well, it's the one trade that did well in the first quarter, right?
Exactly. Can it continue, though, is the question.
It's a good question. All right, Kriti Gupta, she's our Bloomberg Markets correspondent. Check her out on Twitter, on all social media, and get her chart.
Yeah, at Kriti Gupta News and kgupta129 at bloomberg.net. Let's get to Washington, D.C. for a check the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden is in New Hampshire touting his infrastructure bill and the benefits it will bring to Portsmouth Harbor.
We're the only country in the world, I believe, that has come out of every crisis we faced stronger than when we went in. Literally stronger than we went in. That's the history of the journey of this country. And this port is a perfect example. A lot of important things come into these terminals, and particularly this one. From salt to de-ice roads to 85% of the home heating oil used in this state.
Biden says under the $1 trillion infrastructure law, $1.7 million will be used to dredge the harbor's shipping channel and basin. Treasury Secretary Janet Yellen is urging world financial leaders to get concrete as they look for ways to combat a looming crisis over food insecurity that Russia's war in Ukraine has made even worse. Yellen says the threat touches the most vulnerable people the hardest. Actor Johnny Depp says he's been waiting a long time to finally address allegations he abused his ex-wife Amber Heard. He took the stand today in his defamation trial.
But never did I myself reach the point of striking misheard in any way, nor have I ever struck any woman.
Depp is suing Heard in Virginia for $50 million following an op-ed she wrote for the Washington Post. Heard detailed being a domestic abuse victim, never mentioning Depp by name, but he says it has impacted his career. She is countersuing for $100 million. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington. Can I just say, are you
say whatever you want?
Are you having troubles with your chair?
There are no secrets that we keep from our audience here.
For those watching on YouTube, Tim's actually standing right now. I don't know. Are you eating too much for lunch? Your chair just keeps going down.
There's this this chair. If you sit in it for every 10 minutes, it just falls a few millimeters. So by an hour and a half in, I'm just at the kids' table. It feels like.
It's like when you're at the salon and you're getting your hair washed.
No,
and you're
I don't.
You're in that.
Oh
thing
yeah,
and you're kind of comfortable. And then all of a sudden, it just goes down, and you're not comfortable. That's kind of what's happening.
That's what it looked like. Well, I'm standing up now.
All right, now we're going to be serious and go to a story that I actually mentioned earlier with our TV colleagues about housing. First of all, housing stocks, home builders on a tear again today, up about 4% overall. We talked about the housing starts number, very strong. I think the highest we've seen since 2006. Meantime, Blackstone continues to double down when it comes to its housing bets.
The company is spending $13 billion, 12.8 to be specific, to buy the publicly traded American Campus Communities Incorporated. It's an all-cash transaction. It's the largest student housing deal by the Blackstone Real Estate Income Trust, known as BREIT for short. It's $97 billion. Last year, it invested in the industry through a $784 million joint venture with Landmark Properties. Student housing, they are so bullish on it.
I remember years ago, early on in my career, doing a piece specifically on investors and how they play the college market specifically and invest in homes, because it's kind of first of all, a lot of these homes that are off campus, in some places they were pits, to be quite honest with you. But
those college students don't have the highest standards.
No, but they could house 4 students, 6, 8, and they were kind of guaranteed in terms of their payment because it was often
roll
parents.
The keg across the floor.
No. It was parents, quite honest, and they continue to just increase their exposure to housing overall.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. 10-year yield now at 2.94%. We've got equities gaining in a broad-based rally. Investors weighing the resilience of the economy against prospects for aggressive policy action to curb inflation. Oil falling on demand concerns. West Texas Intermediate crude down $5.59 a barrel, down 5.2%, 102.62 on WTI. S&P 500 bouncing back from the lowest in more than a month. Right now, the S&P's up 67, up by 1.5%, very close to session highs as we've got 12 minutes to go to the close. The Dow up 492, up 1.4%. NASDAQ up 264, up now by 2%. Spot gold down $32 the ounce, down 1.6%, 1947 on gold. West Texas Intermediate crude, as I mentioned, down 5.2%, 102.62 a barrel. Earnings after the bell today will include Netflix. Netflix right now up by 3.5%. Also after the bell, we'll be hearing from IBM, up now by 2.4%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
As IMF negotiators try to agree on a bailout for Sri Lanka this week, they'll no doubt push for economic reforms. But any such rescue will fail without political change. An earlier government, led by then-President Mahinda Rajapaksa, saddled Sri Lanka with unsustainable debts. When his brother, Gotabaya Rajapaksa, swept to power in 2019, he packed the government with cronies and relatives and made still more economic blunders. Now, with less than $2 billion in foreign exchange reserves left, the country is running out of money to pay for essential imports. Consumer prices rose nearly 19% in March from a year earlier, and protesters have filled the streets. The U.S., India, and other partners should ease Sri Lankans' pain with much-needed food aid, while pressing for political reforms. Sri Lankans shouldn't have to pay such a high price for their leaders' mistakes. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I don't want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10.5 minutes left in today's trading session, the Tuesday trade. And as Charlie mentioned, we're pretty much hovering near our best levels of the day when it comes to the equity markets. Folks, we have a rally underway despite higher rates and expectations of higher rates. But it does seem like investors either focusing on earnings or focusing on economic growth on a day when the IMF lowered global growth.
It's just one day after we saw the lowest close for the S&P 500 in more than a month.
Volatility, perhaps?
Yeah, it's still happening, Carol. Let's get some thoughts from Eric Marshall, portfolio manager at Hodges Funds. It got $1.75 billion in assets under management. Eric joins us on the phone from Dallas. Eric, how are you?
Well, thanks for having me.
Good. Well, help us make sense of not just a day like today, but of what we've been seeing in the market lately. Carol said the word, volatility.
Yeah, I think, we would expect volatility to be around here for a while. And obviously today, market used the excuse that there were some positive consumer sentiment numbers out, some positive indications on wage growth that really bolstered a lot of the consumer cyclical stocks today. But the reality is rising inflation is going to be with us probably for a while, through most of this year. And that will threaten earnings and economic growth in certain areas, but it'll also create opportunities in others. And we're really focusing on companies that have the ability to pass on higher prices and actually benefit in an inflationary environment by holding hard assets.
Well, let's talk about some of the companies that you're bullish on, because we love talking individual names with our guests, and you sent us a few. Academy Sports and Outdoors. We just had the CEO of this company on. just a few weeks
and
ago.
They're pretty busy.
They have been very busy. Turns out you can't. It's not easy to ship a kayak in the mail, right?
Ken Hicks is who we talked to, the CEO.
Yeah, and this is a company that we hold it in the Hodges Small Cap Fund, and we think it's a retailer with a lot of store growth potential. And one of the things that we like about it, they went public during the pandemic and really used the pandemic windfall as an opportunity to deleverage the balance sheet. So as everybody rushed out and spent a lot of money on sporting goods during the pandemic, they used that to pay down their debt, which now puts them in a very good financial position to organically fund new store growth. So we think that the valuation looks very attractive here, about 7.5 times earnings, and generating enough cash flow really to accelerate their store growth at their choosing.
So help me out here. Well, the stock is, I'm looking at it, it's up about 4%. Is that right today? Up about 4%. What's interesting is Eric had quite a bump since early March, up almost 40%. Are you still buying at these levels? Do you think that there's more room to the upside? And if so, how much?
Yeah, we like the stock. We think that there's room for the company to move another, $10, $20 here based on the current earnings projections over the next 1 to 2 years, looking out that far. And, potentially we think that this is a company that has, is not fairly getting the credit that it deserves because it is tied to the consumer. Everybody's been really worried about gasoline prices and will inflationary factors really cut into discretionary spending, and how will that affect things like academy, sports and outdoors. The other thing is they are kind of on the lower end of the sporting goods chain, so they could also benefit from somewhat of a trade down effect where people still, get back now that the pandemic is coming to an end, get back into things like team sports and need to go out and buy new shoes and cleats and things like that for their kiddos.
Hey, listen, we just want to mention, forgive us for a second, Eric, crossing the Bloomberg terminal. This is coming from the Financial Times, and this has to do with Elon Musk and his bid for Twitter. Of course, he has made an offer to take that company private, excuse me. Blackstone, Brookfield against Twitter buyout financing, Vista Equity. Brookfield also against equity check for the bid, and Blackstone deciding against an equity check for Musk Twitter bid. But what's interesting is we've talked so much about, who might help Elon Musk in his bid for this company and maybe what they might require in order to do that.
Yeah, this coming after the New York Post reporting that Elon Musk is willing to invest $10 to $15 billion in cash for his part of the bid, so he'd still need significantly more money in order to take that company private.
All right, so interesting following that. We're talking with Eric Marshall, portfolio manager at Hodges Fund, $1.75 billion in assets. So in terms of Academy, just quick net takeaway. So like I said, it's had quite a bounce from early March. Is there a level that you would say, okay, then it starts to get pricey, or valuation? Right now it's 41 and change.
Yeah, we think that this stock could easily trade in the mid to upper 50s from here.
All right, so it's got another $8-9 here to run higher. Silicon Motion is another one that you like. What's your feelings on that one?
Yeah, this is a small cap provider of flash controllers that are used in the memory space. So their customers would be someone like Micron or Hynix, people that actually make memory, and they've been growing at double digits. All the semiconductor stocks have really gotten beat down as there's a lot of noise out there right now as far as what's going on with channel inventories. But we think this is a quality name that investors can take advantage of some of the recent pullback here on the stock. And today it's trading about 12 times forward earnings. And we think that they really still have 2 or 3 years of very nice secular tailwinds based on just the overall demand for memory.
Okay, we have 20 seconds left for this last one. Cleveland Cliffs, why are you bullish on it?
we really like the way that their business is positioned as a vertically integrated steel producer. What's going on in the Russia, in the Ukraine, believe it or not, the Russia, Ukraine, and Belarus make up, half of the European steel manufacturing capacity. That's taking capacity off the market, and Cleveland Cliffs is in a great position to accelerate volume as the auto business starts to come back.
All right, we're going to leave it on that note. Hey, Eric, thank you so much. Eric Marshall, Portfolio Manager at Hodges Fund, joining us on the phone from Dallas. That small cap fund at Hodges, by the way, an outperformer certainly this year when it comes to its peers. All right, it is time to join our TV colleagues for our cross-platform coverage, counting you down to the close on this Tuesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic, Taylor Rick, Shanali Bassick in for Caroline Hyde. We're counting you down to the closing bell, and here to help take us beyond the bell, Carol Massar, Tim Stenovec. We welcome our audiences across Bloomberg Television, radio, and YouTube, awaiting Netflix earnings. But right now, Carol, equities right now at the highs of the day, 2% pretty much across the board.
Yeah, as you pointed out, we saw a rally yesterday that ran out of steam, but that's not the case today. We're really keeping that momentum. It does, once again, seem like investors are focusing on maybe the growth opportunities for this economy, especially as earnings are flowing out.
We've increasingly seen a correlation between tech stocks and Bitcoin today, no exception. Bitcoin higher today, off its session highs, but still higher, Taylor, by 1.9%.
Yeah, you really see it. And I know for our radio audience, we've been really pounding this drum, of course, as we've been approaching the closing bell, but it is the real yield, of course, that we are watching here on the 10-year yield that is flirting with positive territory for the first time since March 2020.
We were at negative 0.0025. Just so close, you can taste it, Taylor.
I know.
It's a really seminal moment for markets, guys, and you have to wonder what it means for asset prices moving forward. And to Romaine's point that he was making to us earlier, is it a good thing or is it a bad thing?
We've focused so much here over the last few weeks on the macro conditions, but right now we are going to refocus pretty heavily here on some of the fundamentals, corporate fundamentals here, earnings, that is the growth story with some of the growthiest stocks, Netflix, of course, being the premier one here. We saw what happened last quarter when they reported here, and the guidance they gave really disappointed.
Yeah, right, and put so much pressure on the stock, so it's going to be interesting to see what they say, whether or not they are maintaining their number of subscribers here, Romaine.
And Netflix is going to finish the day about 3% higher, though we should point out it's about the fourth worst performer in the S&P 500 year to date. As far as what's happening today, the S&P 500 is going to finish higher by about 1.6%, roughly 70 points or so. The NASDAQ composite up about 2% on the day, or roughly 280 plus points. The Dow Jones Industrial Average higher by about 500 points, or 1.5%. And real quickly, let's flip it up and look at the Russell 2000. The Russell higher by about 2% on the day. We should point out transports were also higher. The Dow Transportation Average up 2.8% on the day. Netflix earnings crossing the wire, Taylor.
Yeah, let's take a look at this. They are looking at first quarter streaming paid net change. Wow, negative 200,000. That was for estimates being up 2.5 million. That is a big decline here. Netflix now also issuing forward guidance, looking at second quarter streaming paid net change. Also, negative 2 million versus estimates of a positive 2.4 million. So I know we really want to go through these numbers, but you are looking at after that price hike, we know that they had lost maybe 1 million or 2 customers in Russia. Wow. Some big declines here now. Romaine, I know you'll correct me, maybe one of the first times we've ever seen a decline here on a quarterly net change basis. But again, the big headline number, first quarter streaming paid net change, a drop of 200,000 last quarter versus estimates of a 2.5 million gain. And that forward guidance, again, second quarter, also looking at a drop here of 2 million versus estimates of gain of 2.4.
And Carol and Tim, I mean, they're talking here about this idea of trying to re-accelerate viewership and revenue growth. They are making a point here that they are focusing a little bit more outside the U.S. for some of that growth. But we've heard this before, and there really are a lot of questions as to whether we've kind of reached peak Netflix. I mean, everybody is subscribed to this, and the question is, how many more subscribers are out there, Tim?
Look at the third sentence of the letter to shareholders. Our relatively high household penetration, when including the large number of households sharing accounts combined with competition, is creating revenue growth headwinds. For years, Reed Hastings and company were totally okay with people sharing Netflix accounts. We've seen them cracking down or attempting to crack down on that recently, but calling that out in the third sentence in their letter to shareholders.
Well, and what's going to be interesting is the spin potentially on the call with analysts and the investment community because Netflix already a headline. Much of the growth will come from outside the U.S. in the longer term. So will they say, okay, guys, we've got it. We've saturated the U.S. market, Shanali. Our focus in terms of growth will be international. We've heard this before, and we'll see whether or not that appeases investors. Stock down 17%, shares of Netflix.
Yeah, it's actually dropping even further now, 19%. Carol, you're really seeing that the picture was obscured from COVID, and then to your point, the Russia losses here, about 700,000.
Sorry, I just want to jump in here real quickly here. An interesting comment in this release here about them basically declassifying the board. Remember, they had that supermajority structure here. They actually say they are going to remove supermajority voting provisions in our charter and enable shareholders to call special meetings. We're also going to change the voting standard for our directors to simple majority in uncontested elections. This is the big change, guys.
Let's do all of this and more with Geetha Ranganathan, U.S. media analyst here for Bloomberg Intelligence. And Geetha, huge headline numbers. What stands out to you?
I don't think when you think just when you think it couldn't get any worse, it just does, right? And of course, we were kind of expecting them to be in line with guidance. Of course, that is a big disappointment that they are losing subscribers now and again. The 2Q guidance. So this is really bad news for the stock. And I think it's again going to lead to a whole recalibration, a whole resetting of expectations for the Netflix story.
Hey, Geeta, Carol here. And I was looking at some of the reading in on the preview of the earnings. And Bloomberg Intelligence said that download data suggested subscriber gains of 4 million. So even above the 2.5 million that the street was expecting. Is that why we're also seeing such a big drop in the share price? Because even out there in the universe that they were expecting a more aggressive number from Netflix.
Yes, I think so. So I think coming into the quarter, we were obviously looking at download data. Guidance was, as you know, Carol, very, very weak, but we were looking at download data, which did hold up pretty decently versus, last period, 1Q of 2021. And so that kind of gave us some confidence. But then there were a lot of these headwinds that were kind of clouding the outlook. So the geopolitical turmoil, the Russia, no one really knew how many subscribers were there, but looks like it was about 2.5 million probably, which kind of impacted that subscriber number. And then, of course, you have the price increase, and that was always, going to be a big wild card as well.
I'm curious, they talk about here the idea of trying to boost viewership overseas, that could be a growth story for them. But when you look at the numbers for Latin America, you look at the numbers for the Asia-Pacific region and some of those emerging markets here, I don't see that growth just yet. What is going to be the catalyst, if anything, that would actually get them to some meaningful growth in those markets?
I think now it's really going to come down, Romaine, to price. So we've seen Netflix has been able to grow to about 220 million subscribers worldwide. But I think all the low-hanging fruit at this point has been captured. We really are not seeing any catalyst. So I think at this point, they do talk about password sharing, and they talk about 30% of U.S. households sharing accounts. So potentially kind of hinting that they're probably going to crack down in that in the developed markets. But I think in the emerging countries, especially Asia-Pac and LATAM, I think what they're going to really have to do is introduce that ad tier to lower prices and to attract a wider customer base.
Well, that's where I was going to go next here. Why have they been so resistant to embrace that? Something some investors at least have been calling for now for quite some time.
Yeah, they've always kind of wanted to keep this, a pure subscription story, stay away from advertising, stay away from data privacy. But I think now, just kind of seeing the whole subscriber story, just a dramatic slowdown here, as well as Disney Plus kind of finally conceding that the mighty Disney is also introducing an ad tier to get to that target of 250 million subscribers by fiscal 2024. That tells us, something. Advertising is inevitable. You're going to have to do it not just to acquire new subscribers, maybe even to retain your existing subscribers, especially as you have all these inflationary pressures building.
Hey, Geeta, you mentioned Disney Plus. Disney shares lower, as are Roku shares and After Hours now as a result of these. It's fair to say Netflix totally invented a category years ago when it came to on-demand streaming as a subscription. The company says, though, over the last 3 years, as traditional entertainment companies realize streaming is the future, many new streaming services have also launched. The company calling this out as a third reason for the headwinds for the current quarter. I'm wondering how much of this is about competition, about those traditional broadcast companies, about those traditional entertainment companies finally figuring out streaming.
Oh, absolutely. It has a lot to do with competition. We're seeing them not. I mean, obviously, Netflix has a huge advantage. They've been the first to the game. They do have that first mover advantage, but you have everybody now making a bigger and bigger push. And we've seen now the streaming wars almost evolve into these spending wars. If you look at Disney, they're spending $33 billion on content this year. You look at Warner Brothers Discovery, the new media powerhouse, they're spending about $20 billion of content. So all of these companies chasing streaming subscribers in a big, big way. Of course, Netflix itself is spending about $18 billion. But really, to all of that low-hanging fruit, especially for Netflix, seems to have been captured. And so to get that incremental subscriber, they're going to have to spend a lot of money. And competition has been a very, very big factor, especially as you see some of the tech giants kind of get in a much bigger way. And, Amazon Prime obviously being the prime example there with their MGM buy, as well as, kind of getting into sports in a much more aggressive way.
Gita, the thing is that Netflix is losing customers in 3 out of 4 of its regions, including 600,000 in the U.S. and Canada. Forget emerging markets. In the U.S. and Canada, we're also losing customers here for Netflix. So what is that really attributed to? Is it the prices? Is it the inflation that we're seeing elsewhere? Where are we seeing issues with the core customer base?
I think with the U.S. and Canada, and this is what most investors were really fearing, was the price increase. So we did have a substantial price increase from about $14 to $15.50 that went into effect in the first quarter. And everybody was kind of fearing that, typically people haven't been that price sensitive and churn has been fairly low. Netflix has been able to pass on those price increases fairly successfully. But I think this time around, the environment is different. The situation is different. You have this whole inflationary situation going on, and I think people have just kind of had enough. And especially when you have so many of the other streaming alternatives out there that are so much more cheaper, then it kind of really begs the question about whether you really need all those services and pricier services.
Really appreciate your time and analysis. Geeta Ranganathan, U.S. media analyst, of course, for Bloomberg Intelligence, going to be sticking with us because, Carol, I believe that it is time for us to part ways.
Well, just real quickly here, with Netflix shares down 20%, IBM shares up about 3% here in the post-market after reporting earnings. Their Q1 numbers did beat on some of the main metrics. EPS was basically in line, but that software revenue came in above estimates of $5.8 billion, basically rounding up here. Their 1Q revenue in total was $14.2 billion. The street was looking on average for $13.8 billion. And as far as the guidance here, the company's saying that full year revenue growth will be at the high end of the mid-single digit range. Of course, IBM, a very complex company with that transition to the cloud. We'll dive a little bit deeper into those numbers when we get a little bit more time.
Tale of two earnings reports. Yeah. IBM up about 3%, Netflix down about 20%, and it's dragging down shares of Disney and Roku as well. So that will certainly continue to play out into the Wednesday trade. All right, guys, we got to run. Our earnings season certainly off and running. That's going to do it for our cross-platform coverage on radio, TV, and YouTube. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week. Carol Massar along with Tim Stenovic. These are two big earnings reports. Safe to say, kind of older technology, newer technology. But the older technology company, IBM, is the one that's rallying. Yeah, and it's going through its own transitions, but it's up about 1.5% here in the after hours. But Netflix shares dropping like a rock. Their first decline in a decade when it comes to losing customers. They lost about 200,000 customers.
Let's get into it with Dan Morgan, Senior Portfolio Manager at Synovus Trust Company. He's got approximately $22 billion in assets under management. Dan joins us once again on the phone from Atlanta. Dan, we got to go right to Netflix shares just cratering in the after hours here. The company citing 3 reasons for headwinds in the current quarter and upcoming quarter, including password sharing, the pace of growth, and finally, competition as well. What sticks out to you from this report?
Hi, guys.
Hi.
Well, the first thing, when I saw it go across the tape, I read it like 5 times over and over.
Me too.
Because I didn't understand the number, right? We're all looking for 2.5 million, and it was a negative 200,000, and I thought it was a blip on the screen. So it's somewhat shocking. This is a moment I think we're all going to remember, the time that Netflix actually didn't grow their subscriber base, right? Sometimes they've missed the estimates, but in this case, it actually turned negative. The other thing that I could pull from this, based on the comments that they made in regards to the reasoning, is they mentioned competition. And you may remember in the previous reports, they never would really admit that competition was a problem.
Well, they would
just
say
kept pushing by
competition.
it.
They would say competition in the context of anything that took somebody's time, right? They'd call out video gaming as a whole for competition, or spending time doing things other than watching Netflix was how they saw competition.
Right, but they would never mention Disney Plus.
Exactly. Yeah.
Or Discovery Plus or Paramount Plus. The names go on and on.
Dan, we're overstreamed. I mean, we all just look at home. I mean, I look at it and it's like, oh my God, it's like the cable, bundle all over again, and it's getting pretty pricey.
Yeah, and if you think about this too, Netflix still has about 46% market share compared to all these other streamers. When you combine them together, that being their competition, they spent about $10 billion last year in terms of content that they're going to just, take the losses just to compete directly against Netflix. So you've got to imagine that eventually it's going to catch up. And like you said, Carol, we're reaching a saturation point, right? There's only so many more people you can add, going forward in terms of new streamers. So again, it's shocking, this particular report.
The password sharing part is particularly notable, Dan, in addition to competition. The company says that in addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households, including over 30 million in the US and Canada. So they're essentially saying that a third of people who are watching Netflix are not paying. Does this mean that the company has to find a way to crack down?
Yeah, so that kind of goes back to, kind of getting the ship in line, right, in terms of focusing not so much on content and spending a lot of money and having negative cash flow and constantly trying to grab new subscribers, but kind of wheeling in, right, your, 222 million they did on this year so far, 2.19 million number of subscribers, and actually going and building in mechanisms for security and so forth where they can harvest at least everybody who's getting their service, right, which is what they're saying they're not. So kind of taking a step back away from this growth at all costs and focusing on the existing business, the existing customers, and making sure that they're getting properly, the revenue that they deserve for the amount of people they're actually watching.
Hey, so we mentioned what was going on with shares of Disney. Let me just bring them back up. They were down and under pressure in the after hours. Disney was down. It is down about 3%. We saw Roku off about 6-7%. Should we assume, can we make the jump that if this is what we're getting from Netflix, other streaming services, you better watch out?
Yeah, like you said, Carol, in the beginning, I think it's just becoming oversaturated. There's too many players. The price points keep continuing to drop, and it just, I think it's becoming a much more mature market, even with all the new series that these, streamers create. So again, I just think it's just the dynamics are changing, right? In terms of this being a growth sector, it's just becoming much more mature, a lot quicker than people anticipated, especially after the huge blip up we had during COVID.
So Dan, help us out with what's to expect in terms of competition here. Does this mean that Netflix has to completely reset the way that it's doing things? Do investors have to completely think differently about Netflix? It was a first mover. It had that early mover advantage here. But as the company says, over the last 3 years, these competitors have, linear TV networks have started to, build their own streaming services and do it successfully.
Yeah, so I think, again, it kind of goes back to the bigger fundamental question surrounding the direction of Netflix. And, there's a lot of people that think they ought to just, instead of trying to, do what they've been doing with all this competition coming in, like you mentioned, the lower price of the other services, is just kind of concentrate on their existing database, so to speak, and trying to use excess cash flow to buy shares back. That'll grow EPS. If you're having trouble adding new subscribers, try to reduce debt, which lowers interest costs. I mean, there's a lot of creative things that they could do from a financial management perspective to try to get back on a growth trajectory. But, one of the things that I always talk about with Netflix, the stock trades at 34 times earnings on a trailing basis, and the projected earnings per share growth in fiscal year 2022 is a negative 1.4. So something has to give here, right, guys? In terms of how we view this company. Is it a growth company? Is it a company that needs to focus on kind of harvesting their customers and trying to generate free cash flow, buy share backs, and that kind of stuff? Maybe even create a dividend. I know it sounds crazy, but things have changed. And I think this will be a pivotal time that we'll remember when we got this report, and we're just shocked at
peak Netflix. Are we there? We keep talking about peak inflation, peak Netflix. I mean, are we there?
That's true.
Hey, Dan, I think back to a quarter ago when we got just a really bad, guidance that really missed estimates from Netflix. It was sort of this canary in the coal mine for other tech companies that were set to report. And we did see a brutal, brutal quarter for high-flying tech companies. Is this another canary in the coal mine?
Well, it's kind of interesting because if we go back and look at the FANG reporting season, what happened last quarter after Netflix, it was somewhat mixed, right? Amazon was well received, Microsoft was well received.
And then Meta.
Apple was kind of mixed, but it was really the Meta or the Facebook report, as you remember, that really started sending things downward. So, Netflix, believe it or not, even though we include them in the FANG group, the mechanics that are driving their growth are so different than Microsoft, so different than Amazon. You know what I mean, in terms of AWS, and so different than what Apple's doing with smartphones. So I think, we can derive something from this as kind of a negative sentiment coming into next week. We have, all four of those companies reporting. But again, I think we'll have to get more evidence as we move through next week. I think we're going to kick off with Microsoft on Tuesday, and then we have Apple, Amazon on Thursday. So those numbers are going to come trickling in. Google's also on next Tuesday. So I think it's going to be, as each company comes in, we'll get a better gauge of what's happening in these spaces. I don't think we can derive too much from Netflix at this point.
We are talking with Dan Morgan of Synovus. We're talking about Netflix, the stock dropping like a rock in the after hours, down, looks like about more than 20%, 23% here. It's just down so much. Just a quick rehash of some of the headlines following their earnings. Subscriber drop of 200,000 is its first decline in a decade. Streamer projects 2 million paid user drop in the second quarter, so it looks like a continuation we're starting to hear in terms of commentary. Company zeroing in on that password sharing to stem losses, and as we mentioned, the stock plunging, but it's taking down Disney, Roku, Paramount. We're seeing it play out. On the flip side, I want to get to IBM because that's actually rallying in the after hours, but before we do that, what's the
More
call?
Netflix?
Yeah, well, because it's a huge
I know.
one, right?
I'm hoping you'll stick with it for a second.
I knew you were going to be like,
We'll
don't go to IBM. What would you be asking management, the CEO, the senior execs there at Netflix on that earnings call?
Well, I think the key, like we said, Carol, is, what is the future direction of the company? How do we want to manage through this more mature growth environment? And what financial mechanisms can we use to generate earnings growth? Because that's what the street's going to focus on, right? We can no longer.
What do you mean financial mechanisms?
Well, like I was mentioning before, in terms of things that they can do to generate bottom line profit growth in really a very mature top line environment. Maybe they're going to grow revenues by 10% going forward. Just for example. So how do you then equate to getting a 15 to 20% EPS growth rate? Do you buy share back? Do you reduce debt? There's a lot of things they can do from a mechanical perspective to generate growth when you're seeing your actual subscriber growth slowing down. And then also some of the issues that you talked about, which is, how do they get over this password sharing issue and in terms of security and make sure they're being compensated for their content. And so there's a lot of moving parts that are coming out of this report that we haven't really had to confront with Netflix in the past.
All right, should we go to IBM, Carol?
I think we should because the stock's up about almost 3%. Here.
Okay, so IBM posting
I don't know.
sales
We should ask Dan. Dan, should we go to IBM?
Yeah, I'm ready to go.
Okay, as long as you're ready.
Netflix pretty hard.
All right, so first quarter revenue, Carol talked about what the stock is doing, rose 7.7% to $14.2 billion. That's a beat. Analysts were looking for $13.8 billion. The sales results, though, exclude much of IBM's legacy infrastructure business services unit. It was spun off back in November. Dan, what sticks out to you? Because investors are certainly happy with what they're seeing.
Yeah, so IBM is a company, they beat on top line. We're looking for overall revenues to grow about 4 to 5% over the next couple of years. They've got some good tailwinds going for them right now in terms of you've got a refresh cycle in the mainframe space that's going to hit probably in the second half of this year that should help them. They've done a pretty good job in terms of migrating their revenue mix into consulting and software, which is much higher margin than their core mainframe business. And we all know about the Red Hat acquisition they did, a year or two ago. That really gives them a really good foothold in cloud. And the migration towards hybrid cloud, which, I don't want to get too fancy, but it's kind of a cross between using data centers like AWS and Azure and also using your own servers. That's also a high growth for the area for them. So it looks like a pretty good quarter. You just gave me a couple data points, but just based on, what they've been able to accomplish and hopefully get back and actually growing. They had a long series of quarters where they were not able to grow their earnings.
Well,
so hopefully that's changing.
I know. Do you kind of look at this and say, right, I feel like it's been tortured when it comes to IBM in terms of its move towards a more cloud-based world, which we've seen those who saw it coming and jumped on that bandwagon quickly did well. And it feels like IBM's finally getting there. Is that a fair assessment? Is that how you see it?
You know, the way I see it, Carol, because you and I have been at this a long time. We know the tech stocks. You think about companies like Oracle, who have been a little slow. IBM has been slow, right? Microsoft's done a great job, right? Migrating over to cloud. Apple did a great job going from just making Macs to smartphones. So there's some of these older legacy companies that are in the tech space that have been doing well in terms of making the migration, and ones that have not been as fast. And IBM, unfortunately, has been a slower one, but they appear to slowly be getting there, and they're using their cash flow to do mergers and acquisitions like the Red Hat deal to position themselves more into the software and the cloud area, which are the faster growth spaces, and getting away from that more mature growth core business, which is the mainframe, right? We've known them forever for that. So, you know, IBM, unfortunately, has been a little bit slower than, let's say, Microsoft. Does that make sense?
Yeah, no, totally. But the thing is, it's getting crowded, the cloud space. And I'm not saying that we're all, you know, increasingly everything's up on the cloud. So I get it. It's a huge market and you can have multiple big players. But you also have, as some of our reporting here at Bloomberg, you know, reminds us that companies are shifting more of their operations to the internet and to the public cloud. And so does that ultimately, impact these players, including IBM?
Yeah, I still think there's some room, Carol, in the cloud space. I mean, we're going to know more next week with Azure at Microsoft and AWS, you know, with Amazon when they come out and they give their numbers. They're the two top players in the data center space. And later in the month, we'll get some information from Salesforce. They lead in the software as a service space. And you can go kind of down the list, platform as a service and so forth, and who these leaders are. I just think there's still some room left for IBM to take advantage of. I mean, yeah, it's becoming more mature market. Instead of growing at 50%, maybe it's growing at 20%. But I still think there's some room here. And if IBM can make some good moves from an M&A perspective and continue to build out their cloud space, they might be able to come up and, you know, produce 5% top line growth and maybe single-digit EPS growth going forward.
Hey, Dan, we only have a minute left with you, but we want to end on Netflix and go back
obsessed.
to it. Shares still down more than 20%. We're also seeing shares of Disney lower by 3.5%, Roku down by 5.8%. Give us the last word on Netflix and what this says about the streaming environment right now. I mean, this is the company's, first subscriber drop is the first decline in a decade.
Yeah, I mean, it's a pivotal time. It's an amazing period. I don't ever remember them even having a downturn in terms of new subscriber growth. And I think it sets the stage to do a complete relook in terms of the Netflix growth story going forward. And like I mentioned, I don't think we can substantiate the multiples where the stock has been trading based on this current growth cycle. And it really poses some challenges for management in regards to security, and also how do they want to engineer this company going forward in regards to generating earnings growth.
More Bridgerton. That's exactly what they need, is more Bridgerton.
They do. Didn't they do season 2 already?
They did.
They just did that. That's the problem.
It's done, and you can kind of binge away, and
I know,
it's done. Dan Morgan, we love checking in with you. VP, Senior Portfolio Manager at Synovus Trust Company. Shares of Netflix, by the way, down 22% in the after hours.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. We are live at Bloomberg headquarters in New York City, our interactive broker studio. Hey, coming up, we're going to talk with the author of a new book that's out. I feel like it's such a timely topic. War Without Rule, China's Playbook for Global Domination. This from U.S. Air Force retired Brigadier General Robert Spalding.
First, though, let's get a checkup of what's going on in after hours. I got one word, Charlie Pellet, Netflix.
I agree. Netflix, I got one word for you, Tim. Down 23% on Netflix after hours. Story we are watching. Big news out of the streaming service after a decade of meteoric growth that shook Hollywood to its core. Netflix running into a wall tonight. The streaming service lost 200,000 customers in the first quarter. That is the first time it has shed subscribers since 2011. Geeta Raghunathan is an analyst with Bloomberg Intelligence.
Just when you think it couldn't get any worse, it just does, right? And of course, we were kind of expecting them to be in line with guidance. Of course, that is a big disappointment that they are losing subscribers now and again, the 2Q guidance. So this is really bad news for the stock. And I think it's again going to lead to a whole recalibration, a whole resetting of expectations for the Netflix story.
And Netflix projects it will lose another 2 million customers in the current second quarter. IBM reported sales that topped analyst estimates on strong demand for its hybrid cloud offerings, signaling continued momentum for its transition to a business fueled by cloud-based software and consulting. After hours, IBM up now by 4.4%. Best day for the S&P 500 index since the Fed's last meeting on March 16th, when Fed Chair Jay Powell offered an upbeat assessment of the economy. S&P up 70, a gain of 1.6%. The Dow up 499, up 1.5%. NASDAQ up 287, a gain of 2.1%. 10-year yield 2.93% on the 10-year. Spot gold down 1.5%, $19.49 the ounce. West Texas Intermediate crude dropped 5.2%, $102.57 a barrel on WTI. So again, recapping, stocks higher today. S&P up 70, a gain there of 1.6%. Netflix plunging after hours, down 23%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So a day doesn't go by without obviously significant headlines out of China. We're watching their economy, which we know is seeing pressures. We also see Chinese official, the central bank, announcing lots of measures to cushion the economy. And so we watch that playing out in the markets. Government departments today pledging more steps to help companies resume production in key sectors. And I think what's interesting, Tim, this is all against a longer-term backdrop of China's Made in China 2025 state-led industrial policy to really to make China so dominant in global high-tech manufacturing. They want to be the world's dominant power on so many different levels.
They certainly do, and we're really lucky to have joining us Robert Spalding, retired Brigadier General for the U.S. Air Force. He's the author of War Without Rules, China's Playbook for Global Domination. He joins us via Zoom from Washington, D.C. General, how are you?
Thank you.
Hey, it's good to have you with us. I just want to start with what's happening in China right now. We see supply chain scenarios as a result of yet another lockdown, this one, the biggest lockdown in Shanghai. And I'm wondering if that is a weak point for China right now, because you do argue that China has thrown out the old rules of war.
Well, I don't know if it's a weak point or they're actually testing our ability to weather through the supply chain shortages that are leading to increased inflation in our own economy. So it's not just the Fed lifting the money supply, it's also the shortages of, the type of goods that, is adding to this, increasing inflation that is really, gnarling our own society. So there's a give and take here that we have to be aware of.
You are a former China strategist for the chairman of the Joint Chiefs of Staff and the Joint Staff at the Pentagon, also senior defense official and defense attaché to China. I mean, you understand this country, you speak Mandarin, you have watched, I'm assuming, the evolution of this country, which we thought that by being involved would kind of bring us all closer in terms of globalization. But we're definitely seeing a different China play out. Why did you want to write this book?
Well, I wrote a book back in 2019 after I left the White House, trying to explain what I had witnessed during my almost 10 years working on U.S.-China relations in the Pentagon and then as a senior defense official in Beijing. And one of the real crucial documents that I relied on for that book was unrestricted warfare. But unrestricted warfare is so hard to read and inaccessible. I wanted to bring it out and allow regular people and policymakers to really understand the way the Chinese think. And I think that's what War Without Rules is. It's allowing people to understand how the Chinese Communist Party thinks in terms of competition and warfare with the West, which is totally alien to the way we think about war and really doesn't involve weapons at all. And just bring that out so people can understand and anticipate how the Chinese might act or react to any given situation.
What does our audience need to understand? What does our investor audience need to understand when thinking about China's push for global domination? Your words, China's playbook for global domination.
Well, I think for investors, one of the challenges with regard to investing in China, particularly if you have assets in China, is the non-convertible nature of their currency and their strict capital controls. You know, once you've gotten assets there in China, it's very hard to get them out. So that's a problem. And ultimately, if you have a relationship with China, you can find yourself the subject of Chinese Communist Party influence. So Marriott Corporation saw that when they were asked to fire one of their employees that liked to tweet. The NBA saw that, lost revenues when Daryl Morey tweeted. So what happens when you are a country or a company that's trying to either sell to China or in some way be financially related to China, you're going to find that you have to listen to what the Communist Party says, or it can be financially detrimental to your business.
You know, General, I wonder if global companies misread China. They thought by being involved that China would become more westernized. But that's not what's happening, is it?
Well, you know, I lived in China, Shanghai, and went to Tongji University from 2002 to 2004. And all of my neighbors were building factories in the Shanghai Special Economic Zone. And this is what I heard nearly universally, is that we were going to somehow transform China to be like the United States. And I thought that was a little bit arrogant at the time. But yeah, truthfully, what's happened is rather than us changing China to be more like the U.S., they've been able to change us to be more like them. And then again, it's through these relationships where they're allowed to influence our corporate sector, our financial sector, our political system, our academia. So it's a big problem.
Well, and I think it's interesting coming at a time where we're focusing so much on ESG factors and companies saying we've got to take a stand on these social policies. Our workers want it, our customers want it. And yet when it comes to China, you do feel like everybody is so careful and so delicate. General, we're going to come back to you. We're going to continue. We just got to do a little bit of news, but we're going to come back to General Robert Spalding, retired Brigadier General for the U.S. Air Force. His book, War Without Rules, China's Playbook for Global Domination.
Let's head now to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden has been in Portsmouth, New Hampshire this afternoon, where federal money from the infrastructure law is being used to improve the port and to improve other projects. But the war in Ukraine was not far from his mind.
The president spoke after he had another conference call with allies, such as an earlier one, he said, that resulted in coordinated release of reserve petroleum. The war in Ukraine is going to continue to take its toll on the world economy. It's going to take its toll on energy. An awful lot of people are hurting. The cost of a dozen eggs, the cost of a gallon of gasoline. It matters. The president said earlier he would send additional artillery to Ukrainian forces, and more sanctions against Russia are in the works. In Washington, Irv Chapman, Bloomberg Radio.
Independent autopsy results of a black man killed by a Michigan police officer indicate the victim died from a shot to the back of the head. Patrick Lioya was recently stopped by a Grand Rapids police officer, resulting in a confrontation that allegedly ended with the officer firing his gun. Dr. Werner Spitz conducted the autopsy.
The only injury on this body was a typical bullet wound of entrance.
Dr. Werner Spitz says his death was instantaneous. The official autopsy results have not yet been released. The NFL is launching an investigation into allegations the Cleveland Browns lost games on purpose during the tenure of former head coach Hugh Jackson. Sources say the league is looking into statements made by Jackson implying he was paid or offered pay to lose games so they could secure higher draft picks. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, we're going to get back to retired Brigadier General Robert Spalding. We're talking about his book, War Without Rules, China's Playbook for Global Domination. We'll get to that in just a moment. This is actually a story we talked about a little bit earlier.
Yeah, Carol, you mentioned this one. This by our Debbie Wu. It's about the world's biggest iPhone assembly campus. It's in the outskirts of the central Chinese city of Zhengzhou. Is operating normally despite lockdowns and mass COVID-19 testing in the area that began last week. That's according to the official Henan Daily.
So it's interesting. So a surge in COVID infections in Shanghai led to extensive disruptions there. You know that. And Zhengzhou's decision, I think it was late Friday, to implement a quarantine raised concerns that Foxconn Technology Group's facility may have to limit operations. But again, what we're seeing is, and this is something we've talked about, Apple has been pretty amazing in terms of its ability to manage supply chains, including those in China that are under pressure because of COVID.
Yeah, Tesla's done a pretty good job, too. The iPhone assembler Pegatron, the Apple laptop maker Quanta Computing, Tesla, as I mentioned, many other electronics parts makers, they were forced to pause production, causing ripples of disruption beyond China's borders. Japan's Mazda said last week it will suspend production at 2 domestic factories for a second time because of supply challenges caused by China's virus outbreak.
And go ahead, I'm sorry.
Well, what I was going to say is the zero COVID policy, if you do not tolerate COVID at all and it leads to shutdowns or lockdowns, then one COVID case or a handful of COVID cases just wreaks havoc on the supply chain.
Right, and that global supply chain, so much of it entrenched, certainly around the world, but so much in China. But it's interesting, you and I have talked about this, about some companies and their ability to manage that supply chain, like an Apple, even with its exposure to China, or like an Elon Musk, his ability to get that factory in China up and running so quickly when we know it's often typically very tough for an outside company to kind of get themselves set up there.
So when do we see the current challenges happening in China right now show up in our supply chains?
I don't know. I mean, I guess we'll just keep an eye on it and see. We'll obviously see it either in products not around or pricing going up.
We hear from Tesla after the bell tomorrow. Perhaps they'll mention something.
That's a good point. All right, we're going to get back to Robert Spalding on his book in just a moment.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Netflix shares plunging 24.5% after hours. It is the big market story after a decade of meteoric growth that shook Hollywood to its core. Netflix has run into a wall. The streaming service lost 200,000 customers in the first quarter, first time it has shed subscribers since 2011. It's also projecting it will lose another 2 million customers in the current second quarter. Again, Netflix plunging 24% after hours. IBM up 4%. It reported sales that topped analyst estimates on strong demand for its hybrid cloud offerings. It was an up day on Wall Street. The Dow, the S&P, and NASDAQ all advancing. S&P 500 had its best gain since the last Fed meeting, with energy prices falling. West Texas Intermediate crude down 5.3%, 102.51 a barrel. Spot gold today down 1.5%, 19.50 the ounce. The 10-year yield now at 2.94%. S&P up 70, up 1.6%. The Dow rallied 499, up 1.4%. NASDAQ up 287, up by 2.1%. This headline from the Bloomberg Professional Service: New York City has avoided a strike of 30,000 doormen and building workers. Again, repeating, Netflix plunging after hours, down 24%, 10-year yield 2.94%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get back to our guest. With us right now is Robert Spalding, retired Brigadier General for the U.S. Air Force. We are talking about his book, War Without Rulers, China's Playbook for Global Domination. He's a former China strategist for the chairman of the Joint Chiefs of Staff and the Joint Staff of the Pentagon, as well as a senior defense official and defense attaché to China. Go ahead. You actually we have like a million questions.
Yeah, we've been talking during the break, Brigadier General. Something we've been thinking a lot about over the last couple of months is leverage in terms of, what the U.S. has done and the international community have done, the U.K., the EU, the U.S. in response to Russia's invasion of Ukraine. And I wonder if we would do the same thing to China. And the reason why, if China were to do something on an international scale similar to what Russia has done, because that was part of the conversation early on in the invasion. And I'm thinking to myself, the U.S. and global supply chain is so much more intertwined with China than it is with Russia. In other words, we depend so much more on China than we do on Russia. And I'm wondering your take on that. What kind of leverage does the U.S. have when it comes to dealing with China?
Well, I think at this point, very little. They have a non-convertible currency and strict capital controls. Of course, they control most of the industrial-based supply chain of the world. So I think we would be hard-pressed. And I think what China wanted to do with regard to this Russian invasion of Ukraine is to see what other methods we brought out to put pressure on the Russians that they might see in a Taiwan scenario. So I think they have done a good job of insulating their economy from any kind of attacks, whether they be financial or trade related. And they've done even more now and are going to do even more, realizing what we've been able to do with the Russian economy. But again, having a closed financial system really insulates them from a lot of the effects that the Russians have seen as a result of their invasion of Ukraine.
I do wonder, too, when you say closed financial system, and increasingly China has a closed system to the world in terms of how it does things. Will that, since it feels like the end game for China, General, is all about influence in the world on a global scale, but if they continue to cut themselves off in some ways, can they be as influential as they want to be?
No, and I think you saw that when they tore up the trade deal, the original trade deal that was negotiated by Ambassador Lighthizer. I think they signaled that they were going to begin to decouple themselves from the global economy. Now, they're going to take as much as they can before they go, but ultimately, they wanted to make sure that the United States did not have the type of hooks that China has into the United States. And so they weren't going to give up, control. They weren't going to give up. For instance, we've been hearing that they are going to allow their companies to be audited, as per the new law passed by Congress. But I don't think they're actually going to do that. They're going to signal that they're going to do that, but they won't take the full step because they are concerned about the United States' influence over their own economy, something that they want to have influence over ours, but don't want the alternative to happen.
So what's the end game here, though? Ultimately, we've often talked about the world splitting in two. China with its allies, and the U.S. and certain Western nations, although that gets a little complicated too, and its allies. Is that where we're going? And I do think about, as Tim mentioned, our audience, our investment audience, like what do they need to be thinking about in this situation as you put it out in your book?
Well, I mean, like I said before, they have a non-convertible currency and strict capital controls. There's a lot of money that's never coming out of China. Yes, we are resolving into more of a bipolar world. We are splitting apart. I think, for one, I would not be investing in China. And I think there's a lot of people that recognize now that China is uninvestable. I think the corollary that goes along with this, at some point, you're going to have to write off those assets you're not going to be able to recover. That's going to be painful for people, but ultimately, it is inevitable.
But what about companies that have large exposure to China? I mean, a company like Apple, for example, close to 20% of the company's revenue actually comes from Greater China. What about that? And that's just revenue. I mean, you think about what it does with the Taiwanese company Foxconn and other manufacturers there. Does that mean Apple's uninvestable? Well, it depends on what you assess to be uninvestable. I think a Chinese company that can basically wipe out the shareholders, as can be done because the Communist Party basically has full control over their economy, is, I would say, more uninvestable than, say, an Apple. So, yes, an Apple is exposed to China, but ultimately, as we have this decoupling, Apple's going to continue to survive and thrive as a company. And probably, I think, ultimately, they will be within societies that are thriving and more prosperous than they currently are because the supply chains are in China. So, ultimately, yeah, we're going to have a smaller, all these companies that are relying on China for their numbers, they're going to be smaller afterwards. But I think ultimately, as a society, we're going to be better off because there's not going to be this influence of a totalitarian regime onto our corporate, financial, and academic and political systems.
Bottom line, would you say that China is at war with the world, or at least with the United States specifically, and we can't think of war in conventional military modes, if you will? I mean, they tend to wage a quiet war.
Right, and the whole point of a war without rules is to show people that that China is at war with the United States, and it's a different kind of war. It's not a war that we would necessarily fight, but it is one nonetheless, and it ultimately results in less prosperity for American people. And so I think ultimately recognizing this and beginning to invest in ourselves, infrastructure, manufacturing, science and technology, STEM education, these are things that we haven't invested in ourselves in over 30 years, I think will eventually lead us into a more prosperous place.
Go ahead, Carol.
No, go ahead.
Is there the political will to do that? I mean, Washington gets faulted for such short-term thinking, but I'm wondering if there's political will to actually onshore in that way.
And just quickly, if you could.
Yeah, I think that we did it during the first Cold War. We're in a Cold War again. I think we can muster that. So, yes.
All right, going to leave it there. Thank you so much. Really enjoyed this. Retired Brigadier General of the U.S. Air Force, Robert Spalding, his book, War Without Rules, China's Playbook for Global Domination. All right, let's get right to Joe Matthew with a heads up on what's coming on Sound On. What's up?
Hey, guys, we start actually with the war in Ukraine, and a really interesting voice on this. A congressman by the name of Ruben Gallego. He's from Arizona, 7th Congressional District. He's on the Armed Services Committee and was a combat Marine veteran of the war in Iraq. He saw some of the worst fighting there. And his take today on the idea of ground troops, and maybe, is it possible that somebody snuck some aircraft into Ukraine? We've got news from the Pentagon ahead.
All right, looking forward to that. Joe Matthew of Sound On. Let's not forget Netflix, our top business story at this hour. Shares are down 25% in the after hours. Subscriber drop of 200,000. Its first decline in a decade.
Yeah, it'll open tomorrow if this holds at $261 a share. Levels not seen since 2019, Carol.
And a very different market cap as a result. So we'll be watching that. IBM, though, we've seen some gains in the after hours. For Tim Stanovic and the Business Week team, have a good evening.